Everybody, I am Morgan,
I'm Bill.
and this is Coffee
Sweaters.
and Finance. Bill, got a provocative question for you today. Common wisdom is that stocks are riskier than bonds. And though we are not going to necessarily dismiss that, right? That is correct. How might we think of this differently, right? So, put provocatively, three reasons that stocks are not always riskier than bonds.
So generally, it's true. As a generalism, if we're just going to be as simple as possible, stocks are riskier than bonds. But it's not always the case. And the reason why is...
What's number one?
Number one is inflation. Over the long term, bonds tend to return less than stocks. Over the long term, inflation eats away at your purchasing power. If a portfolio is intended to support $50,000 of living expenses today, in 10 years and in 20 years, that $50,000 of living expenses is actually going to be much higher because inflation happens. And if you have a portfolio that's all in bonds, that portfolio likely isn't going to grow enough to support the same level of living expenses. So if you want to maintain purchasing power in retirement, you need to have a portion of your portfolio in equities to maintain purchasing power.
Right, yeah, if you think about, retirement might last 30 to 40 years, inflation running at 3%, well, by the end of that retirement, you actually need, if you were taking out, let's say, $50,000 per year from your portfolio, by the end of that period, you actually need $100,000, right? So are bonds going to get you from A to B? Maybe, but not necessarily so, right? So that's why we might say, well, you might want to lean a little bit more into stocks to reduce the risk of that loss of purchasing power.
Absolutely.
Yeah. I'm going to throw out number two.
Go for it.
And that's kind of a corollary here, is just time horizon.
Absolutely.
Right? So when you think about equities, in any given year, or even shorter than that, every given day, week, month, or year, the range of returns can be quite extreme. So throwing out numbers here, this isn't an exact, but let's say in any given year, on average, stock market returns could be plus 18% or down 18%, right? So that's kind of the standard expectation.
And they've been much worse during some years, and they've been much better during some years.
Right, so this is kind of be like a one standard deviation event, right?
Absolutely.
If you move out 5 years, now that's compressed a little bit. And if you moved out 10 years, that's compressed even more. And certainly when you get beyond 10 years, I don't know if there's been a negative period for large cap US stocks, right? All to say that the longer the time horizon, actually the less risky stocks become, because you have the higher probability of outpacing inflation.
Absolutely. I couldn't have said it better myself.
Basically, you couldn't have.
No, I could not. I'll give you that. Basically, over time, the returns of stocks becomes more predictable when the longer the time horizon is.
Now, is that a guarantee? Absolutely not. There's still risk there. But when we look back at history, certainly higher probability.
Absolutely.
Yeah. Number three reason why stocks aren't always riskier than bonds is that volatility, that is, stocks going up and down, can actually be a really good thing. Who is that good for, though?
It's good for people who are saving.
Yes.
So if you were to take the whole population, you could split it into two camps. A portion of the population is saving, and they're building up their portfolio.
We call those accumulators.
And then there's people who have retired, and those people are spending out of their portfolio.
Yeah, I saw someone call this almost like a mountain, right? So you're accumulating, reaching that peak, and then you're going to start distributing from your portfolio. Hopefully the portfolio is able to maintain its level over that 30 years, but it's like you might fall a little bit below that, and that's generally okay. Yeah.
So what's happening though when you're accumulating is that you're continuously on a regular basis buying new investments. And if the market goes down, it's okay if you're accumulating, because that actually allows you to buy more shares at a lower price.
Why is that a good thing?
Because it increases the odds of having higher returns over the long term.
Yeah. Why don't I just want my investments to go up 10% per year every single year?
Because then on average you're going to be buying at a higher average price every year.
Yeah.
Volatility is good because it allows you to buy more shares when it's at a lower price and buy fewer shares at a higher price.
Sure.
And on average, the more that you buy at a lower price, the higher your expected return.
So if I took that to an extreme, and let's say I'm 30 years from retirement, I might wish for actually 20 years of kind of poor stock market returns, because those are my accumulating years. I'm plowing money into my 401k or IRAs, Roth, whatever it may be, and then ideal scenario, the last 10 years the market kind of kills it.
Exactly.
Yeah. But that's one way where you might actually kind of wish for volatility.
Exactly.
Yeah. So anyways, 3 reasons why stocks may not always be riskier than bonds. Obviously, we're saying that with a grain of salt. Inflation and purchasing power, time horizon, and volatility can actually be a good thing.
Yep.
Thanks, y'all. We'll talk to you later.
See ya.